Boa tarde, todo mundo. Só antes da gente começar, eu queria relembrar que a gente tem tradução simultânea do inglês para o português. Hoje a live vai ser 100% em inglês. Embaixo na tua tela tem um símbolo de um globo. Você seleciona português e consegue escutar a tradução simultânea, caso não queira escutar inglês.
Thank you for that introduction. Good morning, everyone, and welcome to our monthly International Strategy Live for the month of March. We wanted to update everyone after a very volatile few weeks. For those that are new, my name is Raj Patel. I'm the Chief Equity Strategist, and I'm joined by Marcelo, who is the Head of Global Markets and Strategy, and will always, as always, will be our moderator. Today, we plan to briefly discuss the recent news out of the banking sector, but we wanted to mostly focus on U.S. fiscal policy, as it is a topic that our clients have been interested in, and it has been a big driver of inflation and interest rates. Also, the fiscal outlook is uncertain with the upcoming debt ceiling limit that could be reached later this year. We invited Paresh Upadhyaya from Amundi to give us his views and his expertise. For those that don't know Amundi, it is the largest asset manager in Europe with over 2 trillion in assets and is a top 10 asset manager globally. They have 6 international global hubs and local presence in 35 countries. Amundi offers a complete range of products that includes active management, passive management, smart beta, real asset, structured solutions, and alternative management. Marcelo?
Thank you. Thank you very much, Raj. And yeah, I mean, economic policy now is the name of the game. If you think about everything that happened throughout COVID and how we position ourselves, whether it's monetary or fiscal, but we do want to focus on the fiscal side of it today. It's the beginning of everything, and it's also there's a new development right now with the debt ceiling. So I'm happy to have you, Paresh. Thank you very much for joining us. Paresh is a senior vice president and director for fixed income and currency strategies at Amundi, as Raj mentioned, with a lot of experience and expertise. He joined Amundi from Bank of America, Merrill Lynch, where he was a director and senior FX strategist and head of North America for G10 currencies. So again, lots of expertise, advising and helping with all of the sovereign bonds and investments. So I think this is very timely, and I appreciate you joining us for this conversation, Paresh. So of course, why don't we, so several different levels of understanding on how fiscal policy works, especially in the US, given our Brazilian client base. I think one way to start this conversation is maybe take a couple of steps back before talking about the debt ceiling, maybe just discuss fiscal policy in the US as a whole and what happened during COVID and how we got here.
Great. Well, Raj, Marcelo, thank you for having me on this webinar, and good afternoon to everyone joining the webinar. That's a really good question. Fiscal policy has undergone a very dramatic change in the U.S. since the pandemic. As a result of the pandemic, we've seen unprecedented easing in fiscal policy in the U.S. Some of the sums are just absolutely unbelievable. By my estimates, since the start of the pandemic, fiscal policy has totaled nearly 7 trillion. That's trillion with a T dollars. That is almost 35% of GDP. And if you throw in monetary easing that the Fed has done by taking rates to zero, that is adding another 29% of GDP. So if you combine the monetary easing with the fiscal easing, which was probably more consequential in this cycle, you're seeing a fiscal ease of 64% of GDP. That's $13 trillion. And so these numbers are simply staggering. During the Biden administration alone, we've seen 3 important fiscal stimulus bills. We've seen the bipartisan infrastructure law, which was about $1.2 trillion. We've seen the Inflation Reduction Act, which was about $580 billion. And we've seen the CHIPS Act, which is about $280 billion. So that totaled $2 trillion over the next 10 years. A lot of this stimulus is front-loaded to have the maximum impact on growth. And there are some short-term and long-term consequences to this easier fiscal policy. The biggest immediate unintended consequences of Biden's three fiscal bills is inflation. No surprise, you've been hearing about inflation being very large in the US, not to mention globally. But because of all this easy stimulus policy, it has been a big issue in the US. Inflation hit 9% June of last year, and and core inflation hit about 6.6% in September. Both are beginning to ease, but it's because of very easy fiscal policy, along with supply chain disruptions and the shock to food and energy prices from the Russian-Ukraine event, that you are seeing a pretty serious inflation problem. Now, going forward, what has happened with all of these fiscal bills is it has put the U.S. on the path of a growing budget deficit and a ballooning debt to GDP. So let me give you some numbers. The CBO, which is a nonpartisan congressional budget office that provides numbers, their forecasts for budget deficit and for the debt for the next 10 years, is projecting the budget deficit will rise from 5.2% of GDP last year to 6.9% by 2033. So these are sustained deficits of over 6% from 2028 to 2033. We've only been at these levels or higher only 5 times going back to World War II. As a result of persistent budget deficits, the debt to GDP is expected to rise from 97% to 118% of GDP by 2033. And if Congress does not cut spending or make any material changes to the budget, we're on track to hitting almost 200% of GDP by 2050. So clearly, fiscal policy has grown pretty big. I'm happy to go into the CHIPS Act as well as the Infrastructure Reduction Act if there are any questions there, but I'm happy to turn it over to you.
No, that's great. We usually, we have a couple of questions that we are going to ask you if you don't mind, but we also receive questions from the audience. Anything that I see and it makes sense, and I'm looking down because I'm checking my phone. I have the questions here. Anything that it's related to something that we discussed, I usually try to put in during the conversation. If not, we just leave to the end. But that was a great explanation. Then this is a couple of differences between fiscal policy and debt to GDP when it comes from US, and I'm going to compare a little bit with Brazil. Is as an EM country usually don't. It's very hard to say, well, we're gonna be at above 100, 120, 130, whatever the level is for quite some time. Where US, you have a little bit of space, but definitely any kind of developed market, to be honest. But at some point, you're gonna need to reduce, right? So I think this is a great segue towards the second question. So fiscal policy, monetary policy, everything easing, the economy booming, that brought inflation. But now we face another thing. We face the upcoming. I'm sorry.
The debt ceiling.
Debt ceiling, yeah. Mm-hmm. Thank you. The debt ceiling. I was thinking in Portuguese. We call teto de gastos in Portuguese, but yeah, the debt ceiling, which is something it happens every country, but there are some differences specific to the U.S. and how they treat this and how Congress moves this. We know that they will need to do something, especially with the figures that it just drop all the way to 2050 for 200% of debt to GDP. That's impressive, but everything starts small and it's all about politics. So can you let us know a little bit of your insights and thoughts on the issue around debt ceiling and what's going to happen in the next few months in the US?
Yeah. Well, Marcelo, that is going to be probably the most important political issue in 2023 that the Biden administration is going to face. After the 2022 midterm elections, where Democrats lost control of the House, Republicans have made it a very important point that their focus is to restore fiscal discipline, to cut spending, and to start to reduce the budget deficit and the debt to GDP. That's been the biggest focus. In fact, one of the battles as the Republican Speaker, Joe McCarthy, was trying to be elected as Speaker of the House, he received a lot of difficulties from the Freedom Caucus, which is a very fiscally conservative group within the Republican caucus that has made it their singular focus to try to bring the budget deficit. They forced Joe McCarthy to 15 votes before he finally became Speaker to ensure that Speaker McCarthy is going to pursue the Freedom Caucus agenda of bringing this budget deficit down, and meaning that if it takes the U.S. to perhaps default on its debt obligations, so be it. Now, the markets are becoming more nervous than at any other point in the last 20, 30 years, where we've had these standoffs between the executive branch and the legislative branch over the debt ceiling. This is probably the closest that we're going to come to a real battle between Democrats and Republicans. So one of the things that the Freedom Caucus wants to do is they will only agree to lifting the debt ceiling, which will basically keep the U.S. government funded by paying its debt obligations, by paying its budgetary operations, like paying Social Security and Medicare and other entitlement programs and defense spending. But the Freedom Caucus wants to see spending cuts before they agree to lifting the debt ceiling. And this is where politically it's becoming very contentious. The Freedom Caucus actually wants to reform entitlements, Social Security and Medicare, which is in the U.S. is known as the holy grail of politics, that it's untouchable. And as a result, it has been very unpopular move that we might see some of these reforms taking place, and it's forced the House leadership to back off and say, we are not going to cut entitlements. So then that puts the House leadership in a quandary. What do you cut? It is very unpopular to cut defense spending. Both Democrats and Republicans agree that defense spending should continue to increase. That puts entitlements off the table. It puts defense off the table. Then you have effectively a number of discretionary budgetary items that the Democrats, who have the presidency, and don't forget the majority in the Senate, will refuse to agree to any cuts in discretionary spending. And therefore, there's not much wiggle room here. So I would say that right now, the U.S. government is on track to run out of money as early as June, but most likely in August. If the revenue intake in April comes in much lower than expected, it's quite possible the Treasury could run out of money as early as June. But I think right now our base case is that the Treasury runs out of money in August. This will force Congress and U.S. politicians to start debating the debt ceiling, the terms of what it will take to raise the debt ceiling sometime in the second quarter, to be put to a vote as early as June, but as late as July, to keep the government funded. I would say that's probably 85 to 90% probability that we will see some agreement take place that will lift the debt ceiling during by midsummer. But there is a 10 to 15%, which is not inconsequential, that you could see a technical default by the U.S. government. If that happens, there has been plans by the Democratic leadership that will allow the Treasury Department to prioritize spending. So they would prioritize paying interest on U.S. government bonds and the principle of U.S. government bonds and high priority items like Social Security. So at this point in time, that's what I'm expecting.
Okay. Yeah. Well, the markets are calm, right? So that's not an issue at all. I mean, we have so much stuff going on at the same time. But that was a terrific explanation. And just before we move to the next question, one thing that I got from the audience is, what would that mean? Let's say that we go through a technical default, right? Or whatever, the 10-15% chance, of course, estimate. What would that mean for markets? I understand the prioritization that you explained, but how? I mean, of course, it can get very complex, but we can go dive into several different details. But what would that mean, overview for markets?
Yeah. One of the reasons, I mean, Marcelo, to your point, why have the markets pretty much shrugged off some of these concerns is because we've seen the show time and time again, right? Going all the way back to 1994 under the Clinton and Newt Gingrich era, where the government has shut down on a number of times. But in every single case, both sides back down, come to an agreement. And as a result, I would expect that, let's say that 10 to 15% probability that we see some kind of technical default materializes. I think, ironically, the impact is likely to be that treasuries rally. It becomes a flight to quality. That's what's happened in prior instances when the government has shut down. Treasuries, ironically, have rallied, not sold off, because it's seen as the #1 risk-free asset in the world. I would expect, because of those inflows into treasuries, the dollar actually gets stronger because of flows going into treasuries help support the dollar. And I think where you would see the biggest risk off is likely to be your traditional risk assets. Equity sells off. Spread risk like high yield and investment grade bond spreads to treasuries widen, and effectively that's what will force the Democrats and Republicans to come together. Once you see a pretty significant correction in risk assets, that will effectively raise the severity of the crisis and will ultimately lead to a raising of the debt ceiling. Now, one of the most common questions I get asked is, if this happens to any other country in the world, the opposite would happen. Yields would rise sharply and the currency would plummet. The only reason that you don't see this in the US is that the world looks at the US as the #1 safe haven currency in the world. It is the #1 reserve currency in the world. As long as the US dollar maintains that role, I think the world will continue to fund US's budget deficit and current account deficit. The moment there is an alternative to the dollar is when the tables will turn, and you would expect to see the kind of reaction that you would normally see with yields rising sharply, the dollar tanking, and risk off across the board. But until there's an alternative, I don't see that this time around.
100%, which is ironic, as you mentioned. Just before we move to the next question in terms of continuing on the fiscal spending, Raj, do you want to comment as well in terms of, I know this is not the base case, but just for us to get a grasp on your view as well. I'm sure you agree with Paresh, but do you have any other
in terms of market implications?
Yes.
Yeah, I mean, I think Paresh mentioned the 90s, but also in 2011 we saw similar standoff. The U.S. debt was actually downgraded at that point, and
double A, right? That was kind of a fiasco.
Yeah, and so we saw increased volatility in risk assets. Ultimately, there was an agreement the last minute there, so it was a short-lived issue. There were other issues at that time too, so you kind of have to put everything into what was related to the debt ceiling. There was a European sovereign crisis as well at the same time. So there's a lot of different factors, and so I think we'll have to see what else is going on as well at the same time. But you will see this kind of short-term impact on risk assets. But the question is the market become numb, right? I mean, we saw it in 2011, you mentioned the mid 90s, how much will they care? It feels like this time it's going to be even worse than the 2011, based on the rhetoric and what's happening between Kevin McCarthy and his constituents. But we kind of, I think markets for now are kind of ignoring it. And markets traditionally only care when we get close to that period, right? It seems like the market doesn't care about a lot of things that we would maybe think that it should, but ultimately it cares when we get to that kind of tipping point. So I think we'll have to wait and see, but I think I kind of generally agree with Paresh's assessment in terms of what would happen to markets.
All right, thank you.
And Marcelo, if I can just add one thing,
of course.
just to give you a little bit of the mathematics and why this is going to be very difficult negotiations. The Republicans have only a 5-seat majority in the House, of which about 30 members belong to this Freedom Caucus that I've been describing, the fiscal hawks in the House leadership. So if you have 30 that are adamant that they don't want to pass anything, it's going to force Speaker McCarthy to perhaps maybe carve out the Freedom Caucus and to negotiate directly, either himself or other members of these leadership to negotiate with Democrats to try to get this passed. Otherwise, it's going to be really difficult, and therefore it's going to be a roller coaster.
Yeah, and adds a layer of complexity in terms of politics and just negotiation, right? Well, interesting. And so looking forward, just to finalize the fiscal expansion or fiscal policy discussion, Paresh, what should we expect looking forward for this year? And in the light of everything that's happening with regional banks, and we've seen the Silicon Valley Bank and all of that, how would that play out? Are they related? Do the government also think about fiscal expansion or fiscal even hawkish or dovish, whatever they are planning to do? Does that relate also with this topic? Do you see this playing a role in the discussion, or unrelated completely?
Yeah, I think that in terms of when I look at the legislative calendar, in terms of what could the Biden administration pass on the fiscal side for 2023, I think nothing. I think the fact that you have Republicans in control of the House of Representatives, it is the House of Representatives that controls the purse strings, that control spending. They are going to be adamant that they do not want to see any more fiscal bills passed. So the Biden administration will have to rely on the Inflation Reduction Act that will provide some easing in fiscal policy that is front-loaded. So this year, next year, and the following 3 years after that will contribute to growth. But on the other side, I would expect that you're going to see some signs that some of Biden's initiatives, like the student debt forgiveness program, I expect the U.S. Supreme Court to strike that down, and that is actually going to lead to some perhaps contraction in spending, or some softening in spending from, I would say, third quarter onwards. So I think that you're not going to see any meaningful pieces of legislation pass, and really the focus is going to be, as we were discussing earlier, it's all going to be about the debt ceiling in the second quarter. There'll be some talk of maybe trying to see a small increase in defense spending, maybe some spending on border security. All of this, I think, is going to probably be part of the debt ceiling negotiations to try to get Republicans to agree on lifting the debt ceiling if they see some increase in spending when it comes to defense and homeland security.
Yeah, and assuming that debt ceiling passed and everybody agrees with it, and everything goes smooth and well, let's call the first 90 or 85% chance, according to your estimates, that's actually going to put downward pressure on the dollar, right? So your view and I don't want to put words in your mouth, but it's a softer dollar. It's a little weaker dollar going forward, which it is kind of ironic. If everything blows up, dollar goes up. But if everything is contained and healthier, let's call it, it's weakened. It puts some downward pressure on the dollar. Is that fair to say?
Yeah, Marcelo, I agree 100%. I mean, despite the turbulence that we're seeing in markets right now, I do think that the overall trajectory for the dollar for the rest of the year is the dollar bear market that started in October. I think continues as we go through 2023 into 2024. When I look at the dollar as a counter-cyclical currency. So whenever there is any geopolitical concern, any concerns about global growth, dollar becomes a safe haven currency as flows come into treasuries and thereby boost the dollar. But now those two factors seem to be ebbing a little bit. You know, we will talk about geopolitical risk later, but when I look at geopolitics right now, assuming the Russia-Ukraine conflict remains a frozen conflict and certainly doesn't expand beyond the borders, then I think geopolitical risk, I think, is appropriately priced. When you look at the outlook for global growth, what you're seeing is US growth is converging with the rest of the world. In fact, ironically, Europe is going to outgrow the US in 2024. So when you remove those counter-cyclical factors, then it'll be other factors that drive the dollar lower. And I think that will be the twin deficits, the budget deficit that we've been talking about that's only rising, a current account deficit that on nominal terms is the highest we've seen since the mid-2000s, will weigh in on the dollar, because unless those deficits are financed by foreign direct investment or portfolio flows, it's the dollar that usually weakens to try to make up for those deficits. I also think the dollar from any type of valuation metric is extremely overvalued by as many as 2 standard deviations on various crosses. And as a result, I do think that the dollar is likely to weaken in 2023 and not strengthen. And on a side note, one of the biggest trades I have in the portfolio is the Brazilian real. It's one of the stronger currencies I have that I think have been holding up remarkably well. But we all know there's a lot of fiscal issues that you hear a lot about with Lula and Congress. But that's a topic on a different day.
Now we'll invite you again for sure, but this is it's also a longer one. Thank you for reveal. But this might be a good time for us to shift a little bit more towards what's happening in the market right now. We've been discussing fiscal expansion for quite some time now. It's going to be tighter. Also, monetary policy has been increasingly tighter and tighter. And we just saw some consequences on that, Raj. So maybe discuss a little bit on US regional banks and everything that we've been seeing for the past few days. Just one comment before we move. Everything is happening so fast that we've been rediscussing scenarios and try to figure out everything that's going on a speed light.
Hourly. I mean, the news flow is changing, day to day. Like you said, the Fed tightened aggressively, not just the Fed, but global central banks have been tightening for a while. And historically, it does lead to something. The term that's always used is something breaks, right? When central banks move this aggressively, and we saw some cracks. I hope it's not something breaking. I hope it's just little cracks. It started last week, and it actually started fairly benign. KeyBank, which is a small regional bank, started off in the early part of the week saying that they're seeing some deposits leaving. They have to increase the deposit rate, so their earnings are going to be hit because they got to pay more to keep the checking and savings. That was a fairly benign update. It was not good because earnings are lower, but then we came to kind of the real fireworks, right? The Silicon Valley Bank comes out. They had the same issue, deposits leaving, but those became so fast and abrupt that they needed to sell some of the assets that they have to, that are on the other side of the balance sheet. Well, as you were discussing, rates have moved up so much, those securities are at a loss. So they had to take a loss on those assets that they sold to offset the deposits that were leaving. They ultimately were trying to raise additional capital, and they were not fast enough, and the deposit exodus kind of forced the bank to shut down. So that is not an outcome that the Fed, the FDIC, the Treasury wanted. It caused a lot of volatility in the markets. It impacted other regional banks that have similar profile. So people started looking for banks with high deposits that are above the $250,000 FDIC insurance, ones that are maybe in San Francisco, that have high net worth individuals. So you saw a lot of volatility in similar banks, but we saw it across all regional banks. And we saw it with the large cap banks too. So it was kind of no one was immune. The counter to that is the Fed, the FDIC, and the Treasury acted very aggressively. Right? They came out and said, look, we're going to guarantee the deposits for these institutions that are having problems. So I think that helped to calm the markets down a little bit. And then it's probably the worst timing for this. Credit Suisse comes out and says they see material weakness in some of their financial statements. That's some material issues that they're trying to resolve. The Saudi National Bank, which is one of their largest shareholders, says, look, we can't increase our equity investment. And so then there was a crisis in Credit Suisse, which again, Credit Suisse has been dealing with issues for a few quarters. It's not something new, but the timing with what's going on with Silicon Valley, then increased volatility with Credit Suisse. Similarly, the regulators in Switzerland did come out and try to protect or defend the situation. They provided liquidity for Credit Suisse of 50 billion Swiss franc. So that's kind of the lay of the land. We're, like you said, it's day-to-day information. People are looking at other regional banks. First Republic is one that is rumored to try to find a strategic option, including a sale. That was what's reported by the press. And so trying to see if there's a market-based solution. But the central banks, both here in the U.S. and in Europe, have come out to try to defend the situation. Some banks in the U.S. are actually benefiting. Bank of America saw large inflows. They saw $15 billion come into their deposit base, because as people move away from regional banks, they try to see where can we move our deposits, and then moved it to some of the larger, bigger institutions here in the U.S. So that's kind of the lay of the land in terms of where we are now. Hopefully, these are idiosyncratic, kind of isolated issues, and that the contagion can be mitigated by the actions that the regulators have taken so far. And so I think that's how we're kind of viewing it, and we'll have to see the news flow and see how this kind of progresses from here.
And one thing that I was checking this morning, markets and everything. One thing that I realized since yesterday, the 1 month treasuries, they're trading 75 bips below Fed funds rate, because everybody, even though they're 1 month, there's a negative premium for liquidity search. So yeah, everybody's trying to figure out the bigger banks against smaller ones. So liquidity and high quality, it's going to be the name of the game, at least for the next few days, which goes very aligned with, from a different angle, with Paresh was mentioning, like flight to safety.
Yeah, the dollar has had a little bit of a bid recently. It's been maybe a little bit range bound, but it seems to be getting a little bit of a bid. So this problem seems to be solved by central banks without requiring fiscal help.
Yep.
I think the question will be in the future, and maybe Paresh can comment a little bit on this in the political landscape. How do you view the longer term outlook for fiscal? Let's say we do get to a crisis. What's the political landscape if you were to think a few years out? And it seems like there's a lot of polarization, but I'm curious from your standpoint, how do you think about the landscape if there is a crisis and fiscal has to come into motion again?
I would imagine if we see a sort of a pandemic type emergency or a great financial crisis type situation, that cooler heads will prevail, and you'll have Democrats, Republicans in Congress working with President Biden to try to ensure that if there is a crisis that's affecting markets, that it will calm things down. That's what I would expect. But I think it would have to take a pretty significant crisis to see any type of fiscal easing. Otherwise, when I look at the calendar for next year, for 2024, President Biden is up for re-election, and the backdrop for his re-election is going to be a very challenging one. I think when you look at what is happening in the stresses of the banking system, the tightening that we've seen in financial conditions, I think the risks of a recession in the US are probably greater than 50% late this year into early next year. So he is going to be attempting to run for re-election at a time that the US economy could be in a recession, where unemployment, while still historically low, is probably on the upswing. He has approval ratings that are around 44%. That's where President Trump was back during his re-election bid in 2020. That's always a very dicey place to be when you're trying to run for re-election, which you can call that political fundamentals, his approval rating, a coin flip. Then if you look at some of the other polling questions that you've seen, about nearly 70% of Americans think President Biden is too old. I'm not making that my opinion, just what Americans are thinking. That certainly makes it challenging for Biden to run. And within his own party, in the Democratic Party, you have almost 70% of Democrats that do not want him to run again. So with that, it's going to lead to a very competitive election. And the key is, who will the Republicans nominate to run against Biden? Certainly, I would expect the Republican platform to be fiscal austerity, to bring deficits down. That's going to be probably one of the key campaign slogans to run against Biden. And really, to me, it's down to Trump against your governor, DeSantis, who I think is extremely popular. He effectively is like Trump, without the baggage, without all the scandals and the lawsuits. And therefore, the key thing is, will DeSantis be able to hold up under heavy media scrutiny, under what usually unfolds during a campaign moment? And if he does, I have a feeling that DeSantis is most likely going to be running against Biden, and it's going to be a very competitive race. And I do think that the House is up for grabs, given that Republicans have only a 5-seat majority. But the Senate, I think, has a greater than 50% probability. I think it's 60% probability that Republicans take control of the Senate, since there are 5 seats that are toss-ups, all 5 held by Democrats. 3 out of the 5 seats are seats that in states that Trump won. So clearly, Democrats are fighting an uphill battle to retain control of the Senate. That's how I see the lay of the land for 2024.
Perfect. Awesome.
And maybe, Paresh, just one last question from me. I know I mentioned in the beginning, the global presence, and it would be great to get your thoughts on. You mentioned geopolitics, but also, what's your view on markets outside of the U.S. and the international side, just to get a sense, markets, but also economies, geopolitics. Any comments you want to make on that would be great to kind of close it out.
Sure, yeah. Well, let me just start with geopolitics, because we know that there are economic cycles, there's monetary cycles, and therefore, geopolitics has a cycle. So Ian Bremmer from Eurasia Group is calling the current period that we're in a geopolitical recession, and it started during Russian invasion of Crimea, and then the UK voting to leave in the Brexit referendum, voting to leave the EU, and then, of course, nationalist leaders that are turning inward. All of that, I think, is pointing to this geopolitical recession that we're in. the U.S. has been focused on trying to help Ukraine defend itself against Russia by providing as much arms as possible. The U.S. is also focusing eastward, looking at China. The U.S. believes that China is its greatest military, economic, geopolitical adversary, and therefore, while the U.S. has been focusing on the European theater, they have been making this pivot to Asia, and they've been doing it in a pretty impressive way, not being distracted at all. They have been forming military economic alliances in Asia to try to thwart and try to checkmate China where possible. They've created the AUKUS alliance with Australia, UK, and the US, which will provide nuclear submarine technology to Australia to allow this alliance to better defend and keep waters in the South China Sea open. The Quad, which is an alliance of US, Japan, Australia, India, giving it a bit of a military as well as an economic dimension. So these are just some examples of what the US is trying to do to counter the longer term threat that China potentially poses. I'm not saying it is, but potentially. And I think that this is going to have long-term implications on markets. But for this year as a whole, when I look at global growth, I do think that I'm a bit more on the optimistic side. Consensus, I believe, has turned too bearish on global growth. I think the outlook on global growth could surprise on the upside as we move into the second half of the year. And it is the Fed pause that I think will happen in the second quarter that is going to allow a number of central banks, particularly in emerging markets, to begin to ease policy. And the market narrative could easily shift to rewarding countries where inflation is in the central bank target, and therefore allowing these central banks to cut rates. And that will be seen by markets as pro-growth, which will be positive. Also, the reopening in China is happening a lot quicker than people had expected, which I also think is a positive for global growth. So I do think in that environment, I like emerging market equities, emerging market fixed income. I also like, because I think they can rally in this environment. I also think the dollar bear market is to continue, which is another positive for EM assets as well, because you do have the prospects of a weaker dollar that could help boost overall returns. And I do like European equities, but again, nothing is a straight line. There's going to be some bumps along the way, and I think we're seeing a bump right now. But given how swiftly the Fed, the Treasury, FDIC regulators have moved to try to ease the situation, gives me some confidence that my cautiously optimistic view can pan out.
Great. Marcelo, do you want to maybe discuss a little bit in terms of how we're positioned at the committee level? I know we're still in the middle of the current committee, but maybe just tying in with what Paresh said in terms of our views and how we see the world, maybe just to kind of complement that.
Of course. And this is a great, thank you for the explanation. We're actually quite aligned, Paresh. I know we've discussed this before, but we are seeing the market in a similar way. So we are, for instance, overweight in emerging market equities. Same reasoning. I mean, the trend for dollars down, which should provide some support for EM currencies, EM equities, especially for the countries that are well positioned in terms of monetary policy and inflation. Align with that, the reopening of China definitely will support that asset class as well. Now, we've been increasing credit rating for the portfolio for the past few quarters now, both from a bottom-up and a top-down approach. So investment grade for developed markets, for instance, is something that we are also overgrade, which paid off in the currently environment. From a bottom-up perspective, even for the portfolios, we've been trying to increase credit ratings and credit quality for the portfolios. Now, high yield, which was something that we were neutral, the balance between the yield curves going down, especially in the US, but the credit spreads wider, increasing a little bit. I think that was a negative, but still the carry is too attractive for us to move down. European equities is something that we are discussing quite a lot. Again, we are in the middle of the committee, so news about our position should come fairly soon. But I think we have very similar views to what you just beautifully described, Paresh. So I want to thank you for that. You saved me probably 10 minutes of explanation and probably use better words. So yeah, I think this is how we're positioning the committee. We're gonna come out with any tactical moves that we're gonna do in the next couple of days. But better credit quality for sure. EM countries are poised to rally again, not a straight line, but we are also seeing the same movement aligned with the dollar view, the China reopening view. So even positioning with the dollar itself, it's something on the table right now. Going short dollar at some point against the basket of currencies. Great. So I received a couple of questions. A bunch of them we kind of already responded, which are I think you mentioned in the beginning, Paresh, was where do we see the trade-offs? Where I'm trying to translate as you speak, but in terms of if anything, we don't have a lot of wiggle room for the fiscal discussion in the US for the debt ceiling. So a bunch of things are already kind of set in stone, right? We're in stone, and you only have a little bit of wiggle room. So what do you think that both houses or both parties could agree on? Say, well, we're not going to prioritize this, even though it's going to be. And we discussed a little bit in the beginning as the student student debt forgiveness program, for instance. But anything else that you see, first of all, and how? The second part of the question, which is a separate question, how would that impact politics? Of course, it's costly from a politics perspective to be hawkish from a fiscal perspective. Every president wants to have more budget to increase spending and fiscal expansion. So if you can rediscuss or touch on new points on this, please.
Yeah, I may have touched a little bit about this, but when I look at both sides, Republicans will want greater spending for homeland security. So this is for border strengthening the border, preventing illegal immigration in the U.S. Republicans will also be pushing for increased defense spending, which tends to be big issues for its constituents. At the same time, Democrats will want to see an increase in some discretionary spending. This could be tax credits for like the child tax credit, increase in spending for the Obama healthcare insurance. I think that's Democrats will want to push that. I think that a lot of this potential increase in spending that I'm talking about, I think is going to be part of the negotiation process to raise the debt ceiling. So Democrats could agree upon some of this increase in defense spending, increase in homeland security spending, in return for maybe small increase in discretionary spending, and then an increase in the debt ceiling. Republicans may also ask for some spending cuts in certain parts of the budget in order to push through an increase in the debt ceiling. So I think you're going to see a lot of back and forth taking place in the second quarter, particularly in May and June, when both sides are going to bring what their red lines are, where they are willing to negotiate and where they are not willing to negotiate. And this is where I think we're going to see the art of brinksmanship, played by both sides.
Awesome. Yeah.
That should be interesting.
Yeah, definitely. And a question which is more related to the mandates within AAAs or flagship fund, and you can choose different classes. But I think that one thing that we can take away from this specific question is, and maybe that's for you, Raj, when do you think, what would make you, or you in the committee, of course, increase allocation in equities? We are currently neutral in US equities. Multiple seems to be, from historical measures, a little bit stretched, especially in this environment for interest rates and inflation. We're still waiting to see how much earning recession it's gonna be priced in, but at the same time, we have so much support from cash on the sidelines and a couple of trade-offs that we have. So we're neutral right now. What would make you increase the allocation in equities?
Yes, I think you touched on valuation. If you look at the current PE on the S&P 500, just use that as a benchmark, is roughly 19 times. That is the average of the last few years, let's say the last 5 years, is around 18 to 19 times. But if you look at a longer term horizon, it's actually at the upper end, so it's above the average. So I think one trigger could be if valuation got to a point where you say, look, a lot of the concerns around the recession are priced in. The U.S. maybe somehow inflation drops quicker, and you can say that the tightening cycle is over. And so you get the combination of those two that would potentially be a trigger. Valuation plus some better fundamental news on inflation, because I think those are the two things that the market is focused on. And the inflation ties in with the recession risk, right? Because if inflation comes down too much, then and it impacts growth, it ultimately could lead to a recession. So I think there's a balance here. But it would be nice if valuations come down. We did make the change with emerging market equities. The underperformance or the relative multiple there. And this was a recent change. The EM had a strong performance from, let's say, November to January, and then had a little bit of a underperformance for let's say the last month and a half. And so that was what we kind of took advantage of that opportunity to say, look, this is a market that has had, if you look longer term, is underperformed US, trades at a much lower multiple to itself and relative to other markets. And so the idea was here's an attractive entry point for something that's a little bit maybe cheaper, let's say. So I think those are the kind of things that we're thinking about at the committee. The volatility level has increased recently, but that provides opportunities in terms of multiples, right? So I think that's what we're trying to factor in is, okay, has some markets, and again, not just US, because there's a few other equity markets that we look at, are any attractive now in this kind of recent pullback. And so those are the things that we're evaluating.
Well, and as a follow-up, you also mentioned, well, we usually ask you around sectors, right? And the economy is not homogeneous in that sense. And we kind of play out sectors based, mostly inflation and rates, of course, cyclicals. But in this environment, I think interest rates were playing a bigger role. And Alejandro, our rate strategist, was very convinced that before last week, we were range bound for the 10 years between 350 and 4-ish. And now we're back to the low end. Did you change your views in terms of sectors? Do you still prefer the same ones? How are you?
Yeah, I mean, so maybe similar to the view on fixed income, I think the view in the US is that it will be range bound. You can use a broad range of 3,700 in the S&P to 4,200. So as we get lower, it is more attractive, and as we get to the upper end of that range this year, you want to be thinking about that's kind of the upside. So that's the way I think about the overall market. You mentioned sectors. We've had a bias for some of the defensive sectors. So if you think about healthcare, technology, those are the sectors that can do okay in a slowdown, because you do get the benefit from lower interest rates, and you saw that recently. So in the last couple of weeks, those have held in. Some of the cyclical sectors going into a slowdown will do worse. So banks and industrials, for example. One area where we have a positive bias, and as a sector that's more cyclical is energy. Again, energy prices, have collapsed recently.
Yeah.
It's driven by the worries about growth in the US and Europe, based on some of these incidents that we just spoke about with the banks. But ultimately, there's a risk around production because of the Russia-Ukraine war, so supply, and China is reopening. It's coming back. The actual reopening is happening faster. Maybe some of the demand for energy might take a little bit longer because you have some inventories in China. Travel is maybe picking up at a pace that's maybe not as fast to take on that inventory. But I think the view is that energy seems to have some geopolitical issues and risks, and then also the China reopening could help. So that's kind of the landscape around specific sectors.
Awesome. Paresh, I think this is a good time for us to wrap it up. I just want to thank you very much for joining us. It was definitely a pleasure, and all of the views in Amundi, of course. I think it was great to hear from you, your views, analysis, and insights, and of course Raj as well.
Thank you for having me.
Thank you.
You got it. Thank you, Raj.
Take care.
Bye.
Bye.